Let's say you have $100 in a savings account that pays a 1% interest rate. After a year, you will have $101 in your account. If the rate of inflation is running at 2%, you would need $102 to have the same buying power that you started with. You've gained $1 but lost buying power. Most people in today's economic climate are happy just to make ends meet. With record high inflation rates, more than half of us live paycheck to paycheck, making it easy to neglect long-term goals like wealth accumulation. Building wealth takes time, and the longer we wait, the harder it is to do so later on. Despite the high cost of living right now, there are still ways we can prepare for our financial future without changing much from what we are already doing. The following tips can help you build wealth without changing much during high inflation periods. You should start by moving your emergency fund or savings into a high-yield account. You should invest at least a part of any money you have set aside in a high-yield savings account. Traditionally, people have held a savings account at the same bank where they hold their checking account, making transfers between the two easy and quick. There have been many changes since then, including the launch of internet-only banks and the opening of traditional banks to customers across the country through online account opening. Following these changes, savings rates have skyrocketed, creating this new category of high-yield savings accounts. Although you won't earn an interest rate that outpaces inflation, banks are increasing annual percentage yields so you can at least make a bit more on something you are already doing. In contrast to standard savings accounts, high-yield savings accounts typically pay 20 to 25 times as much as the national average, which currently stands at 0.10%. Having a high-yield savings account should of course make up only a small part of your financial portfolio. Considering how this account will actually complement your other savings and investment strategies can help you determine how much cash you should keep liquid. That leads us to number 2. Keep only as much cash as you need. If you're an especially young investor looking to accumulate wealth, cash is there to serve mainly as your emergency reserves to cover unexpected bills as well as job loss. Any money that you plan to deploy for a short-term goal happening in the next 1 or 2 years is best kept in cash. Unexpected circumstances include job loss, car wrecks, home maintenance issues, and health problems. And specific to investors, there is the added dynamic of down markets to manage. Now, when the market's down, pulling money from investment accounts can be more expensive than borrowing. And you are left with a lower share count, which means less opportunity to benefit from an eventual recovery. At the same time, draining your cash reserves when inflation is running high can make sense from a numbers perspective. But the move can also ultimately prove counterproductive to your finances if you decide to spend too much of it. You don't need to keep extra cash on hand just to have it. So if you have excess cash, consider investing it somewhere that will earn you more. In the long run, investing in the market will protect its value and combat inflation. That's why investors need cash on hand, regardless of what's happening with inflation. In the face of emergencies, cash protects investment returns. Number 3, continue to invest. If you are already contributing a portion of your paycheck to the market, you should continue to do so. And so, in a Gallup survey conducted this year, nearly half of us own stocks, mutual funds, or 401ks. Investments, regardless of how the market moves today, tend to beat inflation because the long-term returns generally outpace the current price increases. Historically, the S&P 500 has shown an average annualized return of roughly 8 to 10%, though past performance is not a guarantee of future results. Building wealth over time requires compound interest and consistent savings habits regardless of market conditions or economic conditions. An investor can gain some insight by examining historical returns during high and low inflation periods. Several studies have examined the effect of inflation on stock returns. In most cases, the studies have produced conflicting results. Higher inflation is generally associated with lower equity valuations, according to most researchers. So, according to this, high inflation periods resulted in the worst real returns in almost every country since the 1930s. To have a clear picture, the inflation is subtracted from normal returns to determine the real ones. A decade-by-decade analysis of S&P 500 shows that the highest real returns occur when inflation is around 2 to 3%. Investments in retirement plans can reduce your tax burden, ensuring that earnings from your investments are taxed less, since traditional IRAs and Roth IRA offer tax advantages. If you don't yet have a retirement account open, a Roth IRA is a good place to start, since it can help offset inflation's impact when you withdraw. Roth IRAs let you pay taxes upfront by contributing after-tax dollars. Later, when you retire, you can withdraw the money tax-free if the account has been open for at least 5 years. If you are already contributing to a retirement plan offered by your employer, keep it up so that if you qualify, you receive an employer match and build an even bigger account. You should also avoid taking on more debt. Let's start with the good news. So if wages increase with inflation, and if you already owed money before that, the inflation benefits you. The reason is that you still owe the same amount of money, but now you have more money in your paycheck to pay it off. This results in less interest for the lender if you use the extra money to pay off your debt early. On the other hand, inflation can help lenders in several ways, especially when extending new financing. People seek credit more often when prices rise, especially if wages have not risen the same way. As a result, lenders will gain new customers, right? In addition, the lender earns more interest on those items due to their higher costs. Considering the rising interest rates on everything from mortgages to auto loans to credit cards, you should be cautious about borrowing right now. As financing becomes more expensive, you may be better off waiting it out. If you are in control of your spending during a period of high inflation, you will feel less impacted by the rising cost of goods and services. If you need to get a mortgage or another type of loan, make sure you check your credit score and find the best lender to get the lowest interest rate. One important thing to remember is this: if prices increase, so does the cost of living. Spending more money on living means having less money to meet obligations if earnings have not increased by the same token. With rising prices and no increase in wages, you will experience a decrease in purchasing power. As a result, you may need more time to pay off your previous debts, allowing the lender to collect interest for a more extended period. So even though prices aren't going down anytime soon, it's important to remember that some of our financial habits are helping to build wealth even during this high inflation period. Remembering that we are in control of our habits could play a significant role in getting over this inflationary period and even thriving. With that being said, thank you so much for watching. Don't forget to let me know in the comments if you got any value from this video. It's 2022, subscribe if you like, hit the notification bell if you aren't already, and I will see you soon.